the long-term risk is really out of the market right now, and that people should be, in the coming months, they should be ready to put capital to work, because if and when we see gold, clear 1900, that's really, it should steadily move higher after that. And you definitely want to get in, a little bit before that point if you can. And if not, then immediately after.
Yeah. Welcome to In It to Win It. This is Steve Barton, and I am back with Jordan Roy-Byrne from the Daily Gold. Jordan, thanks for coming back on the show.
Hey, Steve, thank you so much for having me. It's a pleasure to be on with you again.
Yes, you've done quite a bit of content on YouTube lately, and that's been pretty cool. Thank you for putting out that content. It's nice to get a little something every week,
Well, thank you for the feedback. If that's what the people want, I'm happy to produce more of it. And I'm, always looking to produce, share my comments, my analysis on video, and then also interview other people who I think can offer, real value added insights for my audience.
Yeah. Let's start off with what's your current assessment of the economy?
Well, my assessment, and I would say, take it with a grain of salt, because I'm not, I obviously know more than the average person, but that being said, I wouldn't say, economic analysis is my expertise. So I like to put that there first. I think my current assessment of the economy is it's probably going to run into some trouble soon. In the last 18 months or so, there was a lot of fiscal support for the economy, interest rates down to zero again, but that's not that sustainable. And so that is wearing off. The Fed is tightening, or they're going to start tightening policy, which is not good for the economy, but that's the point. They want to tighten and slow things down, trim the excess. And the fiscal support gave the economy a huge lift, but now that for the most part is gone, and obviously the inflationary pressures are still there. In inflation, we saw the latest reading, 7.5%. I think inflation is likely to go down over the next 12 months. However, it could go down to 5%, 4%, 3.5%, 4%. So that's the rate of inflation is going down, but that doesn't mean prices are going to go down. They still could go up. And so
not going to go down at quite the same clip. We're going to see disinflation, not deflation.
Right. But disinflation for a year still means that you're going to see inflation. It's just that the rate of it is going down. And so the economy still has to deal with the 3 or 4% or 5% price increase on top of the 7.5% that we had over the previous 12 months. So there's a lot of headwinds coming for the economy. I know we're going to talk about the yield curve later, but that is diving towards zero. And the yield curve, the difference between long-term yields and short-term yields, when the difference basically gets to zero and the curve inverts, that is a harbinger of recession. Not immediately, but usually, it could be 6 months, 12 months, 18 months. The yield curve, it looks like it's going to invert this year. So I don't think it's that much of a stretch to say that we could see a recession in 2023, or maybe it starts in the second half of this year. But that'd be my assessment for the economy. It's going to need more support at the end of this year, early next year, and I think that's going to be the catalyst for the next leg higher in this bull market in gold and silver.
Okay. Now, you mentioned in your newsletter and just in some of your interviews, we had I'm doing the air quotes, the emergency Fed meeting this last Monday, and it seems like they're going to do 50 basis points maybe in March. How does them increasing those rates, what effect will that have on gold?
Well, generally speaking, now there's many factors to consider, but generally speaking, it should be negative for gold, because the main driver for gold is the direction of real interest rates. So gold is inversely correlated to real interest rates. When real interest rates are rising, that's when gold performs poorly. And obviously, real interest rates recently, they're super negative. But if they're super negative and they rise and become less negative, that can still be bearish for gold because the direction, markets are concerned with, excuse me, the direction. So the direction of real interest rates. And if you look at market-based indicators, they're telling you that real interest rate, they have been increasing, and gold has actually been, its performance, it's been holding up actually really well in the last several months. Real interest rates have been moving higher. So gold has been, disconnecting from that relationship. But to your question, if the rate of inflation is coming down as the Fed is increasing interest rates, that should be negative for gold. However, if there's many times in history where where the Fed has started increasing rates and gold has done well because the rate of inflation has continued to increase even as the Fed has increased interest rates. So I think in this scenario, I think the Fed increasing rates should be negative for gold because I think the rate of inflation, while it hasn't technically peaked yet, I think it will very soon and it will come down. But of course, there's many other factors to consider. But generally speaking, I think that during this particular cycle, the Fed increasing rates should be negative for gold. But the reason it might not be that negative for gold is because this Fed interest rate cycle of hiking interest rates, it's not going to be that long of a cycle. They're going to have to fire their bullets really quick because the Fed, to get back into the yield curve, when the yield curve gets down to zero, which means it's basically inverted, the last three Fed cycles, when that happened, they basically stop hiking when that happens. And so that thing has been, we're around 40 basis points now. And the average, like a month before the Fed starts hiking, is usually 115 basis points. So the Fed really, you don't have to be, if you have knowledge about this stuff and looking at these factors, you don't have to be some kind of economic genius to say the Fed is way behind the curve. They should have been hiking interest. They should have started hiking rates a year ago. And now they really should be winding down. Like they should be doing their last 2 or 3 hikes now. So that's why what's going on with gold is really interesting is, the Fed's about to start this cycle of hiking rates, but gold might be sniffing the end of the cycle already.
Yeah. Okay. Because typically when they stop hiking the rates, that's usually the catalyst, right? Once they finish this, correct?
Yes. If you look at the last 3 cycles, 2 of the 3, gold really took off. Actually, when they did their first hike, or excuse me, when they did their first rate cut. So, for the most part, in a lot of these relationships, they depend on where's inflation going, or do we have disinflation? Is inflation out of control? Is the economy strong? So there's a lot of factors to consider. So I'm not trying to make a blanket statement, but generally speaking, at least in recent history, gold, it usually bottoms when the Fed stops hiking, and then it'll really take off when the Fed starts cutting rates. And we saw that in the last cycle and interestingly, gold bottomed in August 2018. That was a real significant bottom, below $1,200 an ounce. Their last hike was in December. So gold actually put in a bottom 4 months before their last hike, which was that was a little bit ahead of schedule. And who knows, maybe we could see the same thing this time around. But I do think that gold could, the recent strength in gold, there is probably some kind of a war premium in the price. But even aside from that, gold has held up really well, considering it should be breaking down because of where real interest rates are going. But my thinking is, and I'm probably repeating myself, maybe the market is sensing, we have inflation is still really high. We could kind of be in stagflation. The economy is going to get weaker. And at some point, the Fed is going to have to cut rates again, and maybe we'll need more fiscal stimulus. So I think those things are probably coming by the end of this year. And maybe the market is trying to, or starting to sniff that out, that it can see that coming. Everybody's talking about inflation. The Fed has to hike rates, and yes, they do. But as we said, they're behind the curve. The market's ahead of the curve. The market is already discounting lower inflation. But because of that, the market might be thinking the Fed will have to stop, hiking rates very soon, and then they will, go to easing policy. So, yeah, I mean, to answer your question is a real roundabout way to answer your question, but yes, I mean, given where we are here and now in the history that we know, it's very likely that, gold has a really good chance to really take off, when the Fed, after they do their last hike.
Okay.
And especially if, not only is the Fed after that, they will have to cut rates to zero again. Maybe that will be accompanied by, more fiscal stimulus and giveaways to, taxpayers and non-taxpayers.
Yeah. Taxpayers. I like that. All right, I'm going to share my screen here real quick with, this will be this is the gold daily chart. So we're going back about a year and a half or so. I'm sure you recognize this bump. Anyways, I drew a trend line here, which seems to be pretty common with the technical guys, and one down below as well here. And you can't help but notice that we got 1, 2, 3, 4, 5, 6, 7, and bam, we finally broke it. In your latest newsletter, you said don't get out the party hats and start popping bottles just yet. You're looking more at once we can sustain a weekly or monthly close above 1900. That's kind of when I can put on my party dress. Is that what you're saying?
Exactly.
Okay.
Yeah, I mean, weekly charts. I mean, you're showing a daily chart here. But generally, weekly charts are more important than daily. Monthly are more important than weekly, and even quarterly. If you look at the quarterly chart, 1900 is resistance on the quarterly chart. It's the same resistance on the monthly and the weekly. So if you're looking at a quarterly, monthly, and weekly chart, those are all showing 1900 as significant resistance. And so what it means, if there's weekly resistance, that just means 1900, can the market close above 1900 on a Friday? A monthly chart at the end of the month, can gold close above 1900? Because you'll see, if the market is not that strong, hypothetically it could, maybe it trades up to 1910 or 1915, and then it closes the month at 1870. And so that would signal, well, it wasn't strong enough to hold those gains into the end of the month. So that, and when in looking at all these different charts, they're in these time frames, they're telling us 1900 is a very significant level. So when we see gold make a weekly, monthly, and even a quarterly close, when it's above 1900, yes. I mean, the 1900 is the most significant resistance that's left. It's going to be more significant than even the all-time high, which I think was 2170 or 2150, depending on which chart you're looking at. So breaking 1900, I mean, if you close the month or quarter above 1900, that's telling us that gold is going to, basically steadily move to a new high, probably.
Okay. All right. Yeah, I was getting. I seem to get extremely popular when the gold price goes up, and then nobody wants to talk to me when it's down. And so I'm getting more emails and stuff right now about the gold price because it's gone up. And
That's human nature. That's market sentiment for you.
They're like, they didn't want to, they didn't think that $21 was a good price for physical silver a couple months ago, and now I'm getting a whole bunch about it because it's more expensive now.
No, that's sentiment. And one thing about sentiment, which is interesting, is, I mean, it is a contrary indicator, but one thing with, looking at gold over the last 20 years, sentiment, when a market is going to make a major breakout. Sentiment is usually already bullish. So you have to be careful about using it as a contrary indicator when a market is challenging or is about to break a major resistance level. So, 1900, and we could throw in, 2050 or 2070. I mean, if you're looking at a 10 or 11 year chart, you can see this beautiful base that gold has. That's very significant resistance. And so if gold is approaching, those prices again, I wouldn't, even if it's popular and people are talking about it, that's not necessarily a bad sign, because oftentimes what I'm saying is sentiment, at least for gold in the last 20 years, in challenging these major levels, sentiment has actually been bullish before it broke out. I mean, it's more of a problem if you see bullish sentiment when there's multiple, massive resistance levels that it has to challenge.
Yeah. Okay. All right. I'm going to share the screen again with the the yield curve graph. So let me make this bigger so we can see it. There we go. Okay, you can see the 2-year and 10-year curve.
Yes.
Okay. All right. So basically, if if a 2-year, generally speaking, a 2-year bond pays less than a 10-year, right?
Right.
If if you give them your money for 10 years, they will pay you more interest than if you give them it for only 2, right? But there's moments in history where that actually inverts. And when you say the yield curve inverts, that means that we are getting paid more on a 2-year note than on a 10, correct?
Correct.
Now, that is a fairly reliable indication of a recession when a 2-year pays more than a 10. Is that accurate?
Yes. I think there's only one time it hasn't preceded a recession, but every other time it has preceded a recession. And I think the average is like by a year. So I think there's a range in most cases of like 6 to 18 months with, again, an average of like a year. So what that means is if we see the curve inverts, so you see what I've highlighted on the chart, like if you see that go to 0, that basically, and it's diving towards
now on
it.
this one, it says 0.47. So that means that the 10-year is almost half of 1% better, higher interest rate than the 2, correct?
Yes.
Okay.
But,
and once this gets to 0, that's the danger zone, right?
Yes. Once that gets to 0, you're basically looking at a recession sometime in the next 6 to 18 months, like the start of a recession. So, at some point around the middle of the year, I think that'll get to 0. And that's basically predicting we'll have a recession in 23, or, maybe that will invert in the next couple months, and the start of the recession will be the third quarter or the fourth quarter of this year. That's basically what the inversion would forecast. And with respect to gold, you can see here that, and we're looking at the last 3 cycles, obviously history. I mean, there's
That's what each of these
much
vertical
longer
lines delineate here, correct?
Yeah, I mean, the black is when the curve inverts. The red is the last rate hike that the Federal Reserve did. And and also, if you go down to the bottom, I have 2 measures of real interest rates there. Remember, real interest rates are inversely correlated to gold, or gold is inversely correlated. So when you see real interest rates declining, that's very good for gold. And so, generally speaking, the Fed, the yield curve inverts around the same time the Fed does its last hike, and then real interest rates peak and they start rolling over. So that's a bullish catalyst for gold. And I mean, you could see that, they were immediate, for the most part, bullish catalysts in the 2 of the 3. If you look at 2006 and what happened, gold was performing. That was a little bit of an inflationary cycle. Gold was performing. So it was rising as they were doing the hikes. But nevertheless, once they cut rates after that, that was a huge catalyst for precious metals. So basically, to sum up the important takeaways here, the yield curve, I mean, it's flattening, which means it's declining towards zero. So when it gets to zero, that's inversion. So when the curve inverts, around the same time, the Federal Reserve will have to stop hiking rates. And that also means real interest rates, which are rising right now, will peak. And so that should coincide with some kind of a bottom in precious metals. Doesn't mean, precious metals they could put in a low 3 months before it happens or 1 or 2 months after, but this is just, if you're taking like a big picture view,
Yeah.
that's what should happen. And that's why, a lot of intelligent people are saying, when the Fed stops hiking, that's when gold should really start to move. And so the fundamental trigger for that is when the Fed stops hiking, real interest rates are going to decline again. And that is usually, or almost always, the driver of gold moving higher.
Okay. Now, what would cause? What would it? How could I'm trying to look at it from a macro view here? How would you get a situation where taking on a 2-year note would pay better than a 10-year? Like what happens in the system for that to happen? Because that doesn't make logical sense to me.
Yeah, that's a really good question. Well, what happens is when people are, they get concerned about, a slowing economy or a recession coming, they put their money in the 10-year bond. And so they're buying the 10 years. So when you're buying the bond, the interest rate goes down. So you have all this money coming in to the 10-year bond, and that pushes the interest rate, the yield down. And at the same time, usually that happens like later in an economic cycle. And when you're later in the cycle, usually the Federal Reserve is still hiking because they tend to be behind the curve and they're slow. So, I mean, but in a healthy situation, what you would have is you'd have a big spread between the two. Let's say the 10-year was like at 5 or 6, and the 2-year, and the 2-year is a proxy for the Fed funds, by the way. So they tend to follow each other. So let's say the 10-year was at 6 or 7, and the 2-year was like a 2 or 3. They would raise the Fed funds, and the 2-year would rise towards the 10-year. And obviously, when they see the two getting close to inversion, that's when they would stop. And
hiking
rates. And then after they stop, what happens is they want to cut aggressively, and so when they cut aggressively, it tends to do the opposite, where they're cutting aggressively, so the 2-year is going back down. And then when they cut aggressively, the long-term thought is, well, that might be inflationary. So then you see the 10-year, it'll stop falling, and maybe eventually it'll start to rise. And so that's when you have a steepening curve when the opposite happens. But that's, yeah, I mean, the inversion is almost a 100%, perfect indicator of a coming recession, not an immediate recession. So that's an important thing to remember, because, sometimes you'd have to go, we're in a different cycle now, but historically there's a lot of stock market peaks that come, 12, 6, 9 months after the inversion. So the inversion is not necessarily like an immediate sell signal for everything. It's a warning signal. So what we are going to get when it inverts is like a really strong warning signal. Probably around the middle of this year. Could be late spring, early summer, somewhere around there. That's my guess.
Okay. And that's kind of when the clock starts ticking, and you got 6 to 18 months. Okay.
Right. And that's when they have to start cutting rates.
Yeah. Yeah. Okay. Interesting. I like that. Okay. Yield curve. I noticed, I've been a part of your service now for at least 6 months. And I noticed your portfolio, you got about a third cash, 32%. Rick Rules has something very similar. He said he's 65% invested and 35% in cash. What's your thought on that? Is it you're kind of expecting a correction, or is that you like to keep that for your If you have to place a hedge on the other side and you don't want to sell all your miners, but you can generate some cash through like JDST or something like that. Is that your logic there?
Well, I tend to be, I tend to be a little bit conservative. I like to usually keep 10 or 15% cash. So, I have been expecting more weakness. I mean, I have been surprised by the strength in the market. And so it's, I do want to put more cash to work soon. I mean, it kind of depends. I mean, I do like to make it company specific, but at the same time, I do think the current strength, I mean, I could be wrong, but I do think the current strength in gold is likely to fade, at least for a little while. And I'm concerned that, we could see some selling if the war premium comes out of the market, which, it might happen in a couple of weeks or a month or two. And we talked about it before. The Fed, they are going to be hiking. So that should be, that should put some pressure on the gold market.
Yeah.
And at the same time, the Fed, even though they'll never say it, they are political. And so politically, inflation right now is the number one issue. So they might even, I said the yield curve will invert and they'll have to stop, but, maybe they'll hike a little bit more after that just to try and, get another hike or two in because of the environment where inflation is the number one concern. It's not growth. So I think those are some reasons why I think gold is not going to immediately take off. But I do think, looking at the charts of GDX, GDXJ, the Huey, I mean, I hate, I am a curmudgeon. I don't like to make calls, but I do think, I mean, there's really good odds they've probably bottomed, that the worst is probably over. And that's the near-term risk that we're looking at is based on what I just said, maybe we could see the market soften. It'll come off a little bit as the Fed does these hikes. But, nevertheless, in the big picture, the very big picture, there's really good risk reward. And the big picture risk is being out of the market and then missing it when it moves. So I do, sooner rather than later, I do want to go back to being fully invested because that is a risk. And the gold market can be very hard to predict where a lot of times you think it's going to go lower, it should go lower, and then it doesn't. It's a lot different from the stock market. And so I think this is a point in time where I think the majority of the risk, at least the long-term risk, is really out of the market right now. And that people should be, in the coming months, they should be ready to put capital to work because if and when we see gold, clear 1900, that's really, it should steadily move higher after that. And you definitely want to get in, a little bit before that point if you can. And if not, then immediately after.
Yeah. Okay. Okay. You had Rick Rule on your show recently. Nice get, by the way. It looks like I'm going to get him next week. He mentioned in there, and then I'm glad you mentioned it too in your newsletter. You said that he mentioned that he believes exploration is undervalued. So just kind of a quick recap for our listeners. So you have the if you're producing, you're a producer. You're bringing metal out of the ground. You're a developer. You're setting up the mine and building the infrastructure for it. If you're an explorer, you're out there with a drill and you're trying to find it on the mountain, right? And he believes that aspect of this investment is a little underinvested, I guess, or undervalued. What do you think of that?
Yeah, I would tend to agree. I mean, it's really difficult to value those companies. I mean, I should have followed up with him on that. But I do think, and one thing that's interesting is, inflation, rising inflation. I mean, it is a driver for gold and silver. But if you look at when it kind of, gold and silver, they perform best like at the beginning, very beginning, even before inflation hits, because now we've seen inflation over the last 18 months and it's actually hitting the margins of these companies. So a lot of these projects that had really strong numbers, like the rate of return on these development projects, they could have, a couple of years ago, they were good down to 13 or 1400 gold. Now, they basically need 1600 or 1700 to produce a, over 20% annual rate of return, which is what everybody looks for.
Or fuel costs, parts, everything have
Right.
gone
And
up.
so, and also if you look at just the last 20 or 30 years, exploration has not, we haven't seen enough investment there, not just, I mean, also in oil and gas and mining and all these various natural resource industries. And so the fact that there's that, and then you have the inflation aspect, that is going to, you're going to get premiums on like discoveries and new projects where exploration shows, oh, this is, you make a discovery and you drill it out and define it. And, oh, this is a new mine and it can, make a lot of money at $1,000 gold. That's going to have that type of project will have a huge premium on it in the coming years. And so I think that's probably what Rick is getting at. And one thing for me, because I tend to favor, I prefer mostly looking at small companies that have huge production growth potential. So where are the small companies that they're going to be able to build a mine, expand it, or they can build a couple mines, expand those? I mean, to me, that's really what I like to look for. I think everything's risky, but I think it's less risky than the pure exploration plays. What's really interesting in the last 5 or 6 years, some of the absolute best performing stocks, they were producers, but they made great discoveries at the same time
while they were producing.
So, Kirkland Lake is one example. And so that's actually something I'm focusing on in terms of exploration is, these development plays or these small producers, the ones that are spending money and like really trying to make a discovery at the same time. Because if you have a project and you already have the infrastructure there and you're already producing, but you make a huge discovery somewhere else on the property, you can just mine that and then process it immediately. You don't have to build a whole nother, mine, or, maybe you have to upgrade the processing a little bit, but
build a road or something.
It's almost like free money when a producer makes a discovery. I mean, you look at it, KL, I think, is the symbol of Kirkland Lake. You can see how well that's done over the last 5 or 6 years. So that's, in terms of exploration, that's what gets me excited. Like when a producer or a developer, they're talking about, we're producing, we're going to grow our production, but at the same time, we're going to spend lots of money because we want to find a lot more. We want to build up what we have. Remember, mining is almost like a Ponzi scheme in a way, because you're consuming your own product. These companies, you're consuming your own end product. You have to find and replace. So I mean, that's an obvious reason why you would want to invest in these types of companies, that they're going to spend more money trying to find and replace what they're already mining.
It's a diminishing, you're literally eating up your capital every year.
And that's why these companies don't, they don't trade at great valuations. And they're not like great 5 or 10 year holds, the vast majority of them, which is why I tend to look at, a 2 or 3 year period where we can catch a real move in the metals price. And at the same time, the company can be growing production alongside that rise in the metals price, and that's how you can get really huge winners in a short amount of time.
Okay, cool. Well, thank you, Jordan. You guys can check him out, thedailygold.com. Sign up for his newsletter. I do. I love getting it every week, Jordan. The first thing I do is I get an alert on my phone, so when it comes out, then I print it right out, and then I've got it before Monday when the market opens. So very, very cool. I dig it. Thanks again, my friend. Please hit like and subscribe. Share this video with anyone that you think needs to hear it. And thank you for watching. I will talk to you next time.